I will actually.
We're being recorded. Just in case anyone was curious, that's now happening. Honest, please go for it.
So I will actually try to explain how I can transition from CVC to VC as a service. Okay, I'll talk about that portion of it. So Jim actually mentioned that CVC's goal is one is to basically be an innovative corporation in some sense. So CVCs are looking to invest in startups so that they can have a relationship with them. They can learn from them. They can also help them at the same time because they have experience of running large business so that they can help the startups, grow their business as well. But main goal of CVC is to do that, is to have a relationship with the startup and grow. And as Jim mentioned, I think there are a few ways that corporations are investing, and they're calling it a CVC. They're investing mainly from their balance sheet, which also comes with a lot of risk, by the way. It directly affects your balance sheet. That's not a good practice, or that is not a practice I recommend normally. So a lot of corporations are also building their fund and they're managing it through their employees. And while they're doing that, the problem they're facing also, some of the corporate employees, they are not born to be a VC, right? So they are put in that job and being asked that, talk with the startups, collaborate with them, make an investment, have a relationship with them. So that becomes very complicated for them as well. So in some sense, the corporate employees are asked in a CVC to actually have a single individual fund, which is sitting as a part of the corporation, and they're asked to actually invest from that. That is what the form of CVC you have seen traditionally around the world. And I know that some of the large corporations like say Google or Intel or Cisco, all of their corporate arms, and they work as part of the company. So what we're talking about today also is also another item is VC as a service. And I will quickly share a slide to actually show the boundary. So the left side is what we're calling about CVC that Jim and I are discussing, right? That part of the corporation, you can see that within the corporation, an employee or a few employees or a hired expert is running a CVC fund and really starting investing in different startups. Obviously, at this point, we know the areas of investment and everything else. While as the VC as a service, what we're doing, we're kicking out that venture capital or CVC activities outside of the corporation. You see, they're on different colors. It is outside of the corporation, so it is a third party managing your fund and helping you with your investment activities. In the VC as a service model, it is run by a third party, normally an expert. Like I personally manage a lot of VC as a service funds, and we are outside experts with a bigger network. And also the other benefit that the customers are getting through this model is that they get to meet other corporations also who are also using a third party run their fund. Through this model, actually they have better access, more access, and they also have an expert running the fund. They're also able to take care of some of the portfolios for collaboration, and also post investment, they're able to take care of these investments by taken care of by some professionals, which is the third party fund manager that you have hired as a VC as a service model. So that's kind of like the basic difference between these two models. We are seeing continuously that a lot of corporations are coming out of their CVC traditional model of balance sheet investment or making a fund under their corporation to giving the whole responsibility to a third party like us to manage their fund and have them manage it and take care of it, and still being supported for running innovations within the corporation.
I like that slide, by the way. Can we de-share that, Honest, just for a second?
Sure.
Thank you, Morrison. So one thing that I wanted to get into was a little bit about the thing that Jim was mentioned earlier, which is what CVCs as a broad category of investors are looking for, and the balance between financial returns and strategic returns. Because one thing that I know whenever it comes up that I'm talking to a CVC is I'm curious, what's the balance between the two? Which are they kind of weighting more heavily? Are they more focused on money, more focused on strategy? And Jim, I'm curious, because you talk to a lot of these groups, is that ratio changing over time? Are they focusing more on finance or more on strategy in the last couple of years?
It really does vary quite a bit from company to company. You have some CVCs that are very focused on furthering the strategic goals of the entity. But I have seen an increasing trend toward focusing on financial returns, particularly for those CVCs that have established a separate fund. And that's driven by a number of reasons, both the need to show returns, the incentives internally within the CVC fund. So many funds are switching slowly to more of a carry type model that you have within VCs that reward performance. And that tends to obviously cause the professionals that are in that CVC fund to focus more on financial performance as well, since their compensation is tied to it. So still a good variety, but definitely a trend toward emphasizing financial performance, particularly for entities that have established their own funds.
And then, Honest, over to you. With the many funds that you guys manage, have you seen a similar shift in focus amongst your corporate partners? Are they looking for a different thing than they were a couple of years ago, or has it been relatively static in your experience?
So from our experience, actually, it is very similar to what Jim just mentioned. So most of the funds, I think when it comes to a corporate fund, they used to be like only technical goals, right? With collaboration goals that I will work with the startup, I will learn from the startup, I will also try to collaborate with, take the technology functionalities, embed into our product and technology, and can still be competitive in the public company sector. That was the goal, but we're seeing more and more of those corporations now raising their voice that we also want to make sure that we're making some, return. Actually, a lot of our Japanese clients, and we have about 20 plus corporations as our clients today, they're mentioning that make sure my principal is protected at the least.
They do know this is venture capital, right? This is not FDIC insured savings accounts. Yeah, okay.
You're right. Unfortunately, there is no FDIC insurance for the money. Yeah. So yes, we're seeing more and more of that, as you mentioned. So we're seeing a trend where people are getting careful. Also, like if you think about it, a set of employees of the corporation is involved with the CVC operation. At the end of the day, whenever there is a rotation in most of the corporation, and after 3 years, new people come back, they will forget what the motto of that fund was. They will say that, oh my God, this fund has lost all its money and it is a failure. So there is also that thing of transition in culture every 3 years is something that most of the corporations have to deal with. And that's where, the financial return can become very important for the people who are leaving and some people are taking over.
Okay, so keeping our theme to the evolution of corporate venture capital as a broad umbrella that encompasses everything that we've mentioned so far, I've been curious to see how expectations have changed, because one thing that I learned early on when I was covering venture capital is that a corporate investor might be a board observer, for example, as opposed to being kind of a full cloth board member. But it seems, listening to you guys talk, that corporate venture capitalists are not just increasingly savvy, but a bit more engaged than they maybe were 5 or 10 years ago. So Jim, is that changing the expectations for board seats and other kind of traditional venture items from the corporate venture capital perspective and what people demand?
It is, as CVCs increasingly lead investments, they led almost 40% of investments in this past year, according to some sources. Their expectations are changing as well. As you mentioned, 10 years ago, you used to see CVCs largely taking board observer roles. Now you see an increasing mix looking for board seats as well. And there's a number of considerations at play there. When you do take a board seat, that director now has fiduciary duties to the portfolio company, but you want to balance that against the increasing voting rights and information rights and access that you get as a director. So definitely seeing a trend in that direction. And also just generally with terms, most of the terms you're going to see from a CVC versus a VC, the primary financing documents are going to be very similar. They're going to look very much the same. And so the main difference is going to come in some of the special terms that the CVC may ask for. And that's going to vary from CVC to CVC, dependent on what their purpose is, what their goal was. But they will have some terms that they really do focus on, things like information rights. Many CVCs are public companies, and they want or need access to information regardless of what the financing documents say. They'll have concerns about public announcements. Confidentiality. They want to control that message, that story. Even as they become more like financial investors, they still want control over what is being said about their involvement and maybe not broadcasting that to competitors. And I think competitors is still a key area, notwithstanding that you've had some changes in purpose. CVCs still care a lot about if competitors even allowed into the company, either as investors, acquirers, commercial transactions. There often may be some special terms around that you wouldn't normally have with a VC investor. And then I think last is acquisition rights. And that's a key one. And Alex, you may have seen this from some of your discussions with companies too, in terms of CVCs looking for special rights around the acquisition of the company, either a right of notice, negotiation, or even an option to buy the company. And that's going to be more important the more strategic the investment is versus just a purely financial investment.
Okay, so it's interesting to hear Anna's talk about people wanting to protect their principal, and you discussing terms being similar to what they were a long time ago, but with board seats and so forth. Anna, is there too high of an expectation from some corporations about what they can get out of a corporate venture capital fund? Because it is risky. You don't get full control, and at least theoretically, startups should be agile without having to worry about a large public perhaps company. So is there too much demand from the corporate side, or are their expectations still in keeping with what the modern startup is willing to put up with?
I think, it is understandable their demands are, right? I mean, some of the corporations, especially if you're looking at corporations in the Western world, like in the US and Europe, they definitely want a little bit more control of the startups. They are treating it as like they're investing as a, private VC. So they keep it at that. Most of the hires of these corporations are also from the regular VC community. So they tend to have that mindset. Whereas if you are looking at some of the Asian counterpart there, I mean, they are looking at more informational rights. And the reason is being that as a public corporation, they also have some, responsibility to the market that they need to disclose this and that information. So that's where I think the informational right part that Jim just mentioned come from, that they also have the obligation to disclose it to the public market and to the government, to the market itself. So that's where it comes from. I think if we stand in between and actually help them out, manage that expectation that what is possible and what is not possible, that's what I do quite a bit. The cultural gap is just amazing. I mean, their expectation is here and this expectation is here. And I see that I deal with a lot of foreign clients there. And one of our job is to actually bridge that gap. And that's where we help a client from Taiwan or a client from Indonesia to come to the US and partner with a startup in Silicon Valley, where the expectation has a big gap. And we try to bridge that and minimize that gap. We also have that practice, as Jeb mentioned. In most cases, we'll try to have an informational light at the least so that the information can flow. If we are investing a significant amount, obviously we have the right to be a board member. Sometimes we, as a VC as a service model, we run the board. Sometimes we also open it up to our clients. But in most cases, our clients want us to run the board because they think that we are better fit to be able to help the startups in some sense. And they have all the information flowing through us so that they can also collaborate and work with them at the same time.
Does that make the terms a little bit more difficult to come to because the company that's providing the capital isn't actually taking the board seat? Or is that a relatively easy arrangement that doesn't require undue amounts of paperwork and confusion?
Actually, it is. We're doing it on a day in, day out basis today. I mean, they are very used to it. Sometimes they really want to work very closely with the startups in that case, and they have a lot of subject matter expertise from the corporation's part. So we actually recommend that you should be on the board because you can help them more. At the end of the day, I think we educate our corporate clients at the same time that you are becoming a board member of a startup because you need to help them. It is not to control them, right? The concept is different here. So I think, from control to help, I think is the new word that we actually try to educate them with. And that's our job as also the fund managers to make sure that our clients know what they're getting into.
Right. It's a lot of money. I mean, having expectations is perfectly reasonable, but given how much traditional venture capital there now is, Jim, I mean, there's so much money in the private markets today. It's almost bonkers. if terms get onerous, it's going to be hard to get into a deal. But I'm curious, because you and I both sit in the venture and corporate venture world, we know that the traditional venture capital world has had a crazy couple of quarters, just super active deal making, fast velocity, high valuations, and competitive terms. Is that showing up as well in the corporate venture capital world, Jim? Or is it as competitive and heated as the Sequoias of the world?
Definitely. I mean, the CVCs are competing with the VCs for those investments. And so some of these special rights that they want, they're going to temper their expectations if it's a really hot deal in a really hot space. So,
Got it.
Alex, just as you mentioned, it's been really active here over the last few quarters, particularly in the life science side, for example. So if you're trying to get in the next hot oncology drug and there's 4 other VCs at the table and you're going to be a follow-on investor, not leading the round, you're not going to walk away with significant M&A rights, for example. You're going to have to temper those expectations about what you're going to get and what special rights you're going to get. And so it's really going to vary based on the how hot the market is, and it's been pretty hot in a lot of areas right now. So you're going to have to make sure that what you're asking for, the package that you're giving, and maybe you're going to give more on the valuation side to get some of these other rights, is attractive to those startups.
Okay, that makes sense to me. And then, honest, kind of the same question over to you. Has there been the ability amongst kind of the Pegasus LP companies, partners, if you will, to be able to move fast enough to make deals happen? Because I keep hearing from founders that, this deal came together in a week, these deal came together in a week and a half. It seems like there's never been less time to get into a deal and get to a yes. Is that possible with your model?
So actually, this is actually a funny thing to tell you, that is one of the reasons why they do VC as a service is to be faster in the decision-making process. So they take one approval through all their board meeting and stuff. It takes 3 months maybe. And then they take a chunk out of $50 million. They actually come and tell us that, hey, run this VC fund on our behalf. And let's create some protocol so that we can actually involve the right people to get a timely decision out at the right time. So I'm sure that, for making an investment, we have to go back to them and ask them that, hey, you guys feel comfortable about this deal? We're going to make a $25 million deal. And that's what we did last year. We're making an investment in a media company. We ended up investing $35 million, and $25 million was coming from a corporation. And we could complete the whole deal within 10 days from the beginning till end, because it was a hot deal. Google and Facebook and Alibaba, everybody was investing together with us. So we had to make that happen. So how did you do it? We had an approval on the whole chunk already by the board. And now we have a fund, and then you can invest from the fund. So CVC creation actually helps you with that process. Then you do not need to go back every single time. And that is the balance sheet investing that we originally discussed. That is the difference between a balance sheet investment and making an investment, making a fund. Especially if it is managed by a third-party VC as a service, then you have full freedom. You just have a quick chat with your counterpart and see who are the persons you need to talk to. You can come up with a scheme as well. For example, for most of the funds that you manage, you also come up with a scheme that for how much money investment, who I should talk to and make sure that they feel comfortable with it. We also create a scheme within each funds and do it that way. And that's how we can do speed control. If you're looking at investing in top hot startups, like say Y Combinator startups, this is hot, right? I mean, those deals are out in 1 week. After they present, within a week, you have nothing left. Everything is gone. So, but our partners, like all of our Japanese corporations, and there are 20 plus of them from Japan, they are investing in Y Combinator startups every single year. And how they're doing it, they have created a special scheme for Y Combinator so that, within 24 to 72 hours, they can come back with a decision to us. And we are still able to make investments side by side with Sequoia and Google of the world and being competitive.
And that is the power of brand and why startups still go to Y Combinator. Honest, I want to stick with you for a second, because this morning I was podcasting and I noticed that Salesforce Ventures, I would say one of the better known corporate venture capital groups in Silicon Valley, had made a deal into an Indian startup. I forget the name of it now, of course, because we're live. So of course it's left my head. But I was a little surprised to see an American CVC lead a deal in an Indian software company, India-based. It's based in Bangalore. And because to me, it's always been a little bit geographically constrained. And so I'm curious, are you seeing more CVC investments go cross-border than we might have 10 years ago, say?
Absolutely. I mean, if you look at, if you're comparing 10 years ago and what is happening now, I mean, most of the CVCs are very global. Indeed, I actually make now 50 to 60% of my investment is still in the US, mainly in, Silicon Valley and the East Coast because of the Boston region. And then half of my investments are happening in Tokyo, in Southeast Asia, countries like in Indonesia, Vietnam, where all the supply chain is moving, right?
Right.
And also we are making some investment even in India, as you mentioned. We literally made an investment in India in one of the, gaming company called MPL. And it was a pretty popular company as well. So most of the CVCs, they're looking at collaboration, right? And collaboration come from two different areas. Obviously, they're looking for top technologies, and top technologies are coming from not only the US company, but many of the Israeli companies, for example,
Sure.
many of the German companies. And we're investing a lot in Israel and German as well. And many of the top consumer-related products and technologies are coming from Southeast Asia. We have made 40 investments in Southeast Asia in the last 5 years. So it is becoming global, and CVCs are interested in expanding their horizon. It also, by the way, as a VC and as a fund manager, it helps us with the risk balance because you're not dependent on a single region to actually make our overall return and make our overall success story.
Yeah, that helps. Jim, a similar topic over to you about what you're seeing from your clients. This ability to look outside the country that a company might be in is cool. But I mean, we both recall back in the day when people wouldn't invest outside of like Mountain View in Silicon Valley. So I'm kind of curious, have corporations been as quick to raise their gaze and look into different regions as traditional VCs, or are they following the other VCs that we know?
Yeah, I think they are. It depends, really varies. We're seeing it both in terms of expanding domestically, just as you mentioned, not just looking in the Bay Area, but across the US and then globally as well, particularly Japan and India. We work with a lot of Japanese CVCs as well that are really looking globally. And when you have a global company, I think you tend to look more global in terms of your investments, because if you're following that strategic direction of your company and your company is now doing business significantly here and there and over here, your investments are going to follow because you're trying to stay on the cutting edge of that technology and really expand your R&D and collaboration as well. So, we've seen some CVCs are on the forefront of that. We've seen others that are sort of following the trend. But in general, the overall trend, just as Anis mentioned, and you mentioned as well, is this expansion globally in terms of where the investments are located and where they're coming from as well.
Okay, I want to stick with you, Jim, because we've had a couple of questions come in from the audience, and just skimming them, they mostly appear to be from founders. So I want to bring up a question that I wasn't sure we were going to get to, but we've all seen a change in how startups are funded, especially at the early stage. We've gone from all price equity rounds to capped notes, safes, all sorts of innovative mechanics for getting capital into companies quickly, and people even say fairly. Are CVCs hip to all of that, and are they willing, in your perspective, to go along with the prevailing financing methods, or do they prefer a more traditional, priced seed round, for example?
I would say that we've seen CVCs move earlier and earlier in the ecosystem. So whereas 5-7 years ago, you may have seen CVCs really investing in later stage companies that are already further along, they've come much further along in terms of doing seed investing. A lot of the investing does still follow the more traditional kind of seed investments, but you are seeing them participate as well in current financing vehicles, whether that's safes, convertible notes, otherwise. They definitely have moved in there. Some have got there quicker than others. Again, there's a variance still in terms of what stage those investors are looking at. But overall, the trend has been to move earlier and to participate, not as much as VC investors, but increasingly so in some of those, in whatever the prevailing instruments are of the time. And here, safes, convertible notes, certainly.
That was a brilliant segue to what I wanted to bring up next. So thank you for that. That was ideal. honest, I was thinking a lot about what you guys run, and whenever we've talked, you've mentioned $35 million funds, $50 million funds. So sizable amounts of money, but certainly not an Andreessen Horowitz $1 billion behemoth. And so I'm curious about the mix of investing stages that you see, and what portion of things that go through the Pegasus model end up being seed versus, say, Series A or Series B, and how that's changed in the last couple of years. Because I'm curious if there's been a focus shift among corporate clients in terms of what they're interested in and how early.
Most of the corporations, if I take a data of 10 years, for the last 10 years, I mean, as you're doing the VC as a service model, where the corporations are investing through us, so we get to hear what they want to do, want us to do in some sense for them. So most of them are interested in advanced round companies. I will say Series A plus, let's put it that way. So they're looking at Series B as the main, because they want to make sure, as many of my clients are coming from outside of the country, right? They're sitting in Japan or China or Taiwan or other countries. I mean, they're also looking at, working with the startups and giving them a global expansion experience. So that's what their main goal, right? That they want to work with the startups and help them expand their horizon into big Asian market, because 2/3 of the world population is living in Asia, right? So that's what they're looking at. So when they're trying to do that, as you can guess, I mean, most cases, it will work out for them if the product and technology has already seen some light in the US market, right? In the local market, or in the Israeli market, if they are as an Israeli company. So we are seeing a lot of interest on the later rounds. However, people are also realizing that it is becoming so difficult to get into the competitive deals at Series B. So we are encouraging them that why don't you get into some of the deals at a very early stage? And that's where my last comment came in, Y Combinator, right? Take stars. Some of the top incubators are becoming their targets, that they would like to meet those seed round companies who are going to become the next unicorn. And don't get me wrong, but we have been able to invest in some top companies in the quantum computing area, for example, and they all came from Y Combinator. For example, Rigetti, one of the biggest quantum computing companies in the world, comes from Y Combinator, and I was one of the seed investors. So same way, like some of the top seed round companies are becoming the next unicorns. And if I'm an investor at the seed round, it helps me get access to the same company at Series A, Series B, when my client is ready to bring them to Japan and do a bigger expansion in the Asia. So that's what is happening right now.
It's fascinating to have this conversation, because I feel like we could almost swap out CVC in some context for just VC, and these trends would hold up, because a lot of the stuff we're seeing on one side of the fence appears to be leaking over, funds going earlier, fighting for allocation at Series B. Thematically, this is very similar to what I hear from non-corporate venture capital players. In my mind, for some reason, I still have like Intel Capital in my head as like what a CVC is. But in reality, that's outmoded. Intel Capital is still a great firm, don't get me wrong, but like much scrappier, shooting earlier. I mean, the stuff that I'm seeing elsewhere really does seem to apply here on us. And maybe I shouldn't be so surprised by that, but I didn't think we'd end up this close to conversations that I have about other things. But Jen, quickly, fund formation. I know that Honest has a bunch of companies that have come to him to help build funds, but I'm curious, from your perspective, are we seeing more companies put together new investing vehicles than we did previously? Are companies kind of getting into the VC boom that we've seen in the last couple of years?
Definitely, and it's across industries too. It's not just the traditional types of companies that you think of in terms of technology or life science companies, although there certainly are quite a few of them, but almost every industry that you can think of, companies in that space are forming it. I think according to CBI Insights, there's been over 1,400 new CVCs that have entered the market in the last 5 years. So this is across size of the company, across technologies, across industries, and like we've said, geographies. So really you're seeing more players come in. One thing that's been interesting too is with obviously some of the disturbances in the economy this past year. Traditionally, if you look back in 2008, the worry was CVCs would be the first one to the door. Anytime that there was some economic uncertainty, they'd pull the funds back and stop investing. That hasn't happened right now. You're seeing good continued activity. In 2020, they participated, I think, in 25% of the deals. And those deals made up 50% of the value too. So they were participating in big deals as well. So we've seen continued investment in, again, coming from across a wide range of industries.
So again, a beautiful segue into the COVID topic. Honest, we're sadly still inside the COVID era. I haven't left my house really in a year, and looks like 6 more months of being a hobbit. But I'm curious what impact COVID had on your business, and if there was any stress amongst kind of the Pegasus customer base about kind of just conserving cash during a pandemic and recession, and frankly, just a multi-quarter period of uncertainty. How did that impact your business?
So luckily enough, we have not been impacted that much. Obviously, we still miss, working under the same roof. But other than that, I mean, in terms of like our growth has not stopped, and we have not seen any of our corporations are coming to us and asking us that, hey, slow down. We should not spend any money. So they have never told us to be conservative. Actually, we are receiving the yearly report from some of our corporate partners, and they're complaining us that we did not do enough investment last year. And I had to explain to and remind them that last year was a year full of COVID situation. So, I mean, they're a little bit impatient, and they're asking us to double our number of investments in 2021. And I think 2021 will be a glorious year for sure, with all the vaccines in play. But, we have not slowed down, and our corporations have not asked us to slow down. So that's the great news. We have seen minimum impact of COVID into the venture capital industry, at least on the corporate venture capital industry part of it, for sure. Has some of the investors are conservative? I think, yes, some of the investors are conservative at this point. They're watching out, and they're being careful. They're cautious more, for sure. But I will say that most part, people keeping things as normal as possible.
Okay. I mean, the funniest story of 2020 was how in March, everyone was terrified that venture capital was done for 2 years. And then by, early May, everyone was writing more checks than ever before. I'm still trying to figure out precisely what happened in that 8-week period, but it's crazy to watch in real time. But I guess I'm not too surprised, honest, that people did come back around and wanted to keep spending. On the 2021 point, are you going to be able to deploy that much more capital this year than last year?
I am hopeful that 2021 will be a better year for sure. I want to see more activities. I want to see more startups coming up. The SPAC movement has, triggered the fire. I mean, how can you, avoid that? So we are looking at every single SPAC. Actually, some of our companies are going to go through IPO this year through the SPAC process. So some of our investors are also very hopeful that, they will also be able to be part of that. And that is normal. I think that expectation is normal. And it is our job as Silicon Valley-based investors to make sure that our corporate clients can also enjoy that trend that you're seeing in the market. But with the SPAC in play, there are 243 SPAC IPOs in 2020 during the COVID. And it is going to be it's going to be much bigger this year. That's what my expectation would be. And I want to be part of that.
This is why the bags under my eyes have gotten progressively larger in the last year, because someone added SPACs into my workload, and I'm still rather cross about it. Jem, a little bit off topic for the corporate VC versus VC world, but I'm curious while we're on the topic, amongst your relatively diverse client base, what's the appetite for SPACs in general? Is it voracious, or is it more muted?
There's a lot of interest. Okay. It's capital, and it's a great way for some companies to explore going public, to access capital, not only in the transaction itself and through pipe investment that usually happens contemporaneously with it, but to get public in a different mechanism. And there's so many SPACs out there right now, and so much capital floating around that needs to get deployed just based on the timeline of how SPACs work. But there's certainly a lot of interest. So we're just discussing with a life science company the other day, different options for their next financing, whether that was going to be a private round, a SPAC, or a traditional IPO. And that conversation is happening with nearly all companies at a certain size. So, different companies are taking different approaches to it, but there's a lot of interest. It's something that nearly every company that's of a certain advanced stage is taking a really hard look at.
Okay, now it's 42 minutes into our hour together. So if you are with us, we have a number of questions that have come in, but this is a great time to drop your question over into the Q&A function on Zoom, because we're going to get to those in just a couple of minutes. I have a couple more quick ones, and then we're going to turn the baton over to the audience. So please feel free to drop in your hottest, best, most interesting, well-spelled, and non-profane question, and we might get to it here in just a couple of minutes. Honest, just a couple of short ones. Price sensitivity seems to have gone out the window amongst many VCs that are on the non-corporate side. I'm curious about your customers and your clients and your investing base. Are they similarly not concerned about what's happened to early stage prices? Just for the founders out there who might be curious about that impact.
Actually, we are, and we advise them on the pricings and stuff, and we are looking at the valuations of each companies very precisely, and we are comparing it against all similar companies, and we're also giving our clients the right advice in some sense. I feel that during COVID, we have because most of the startups also got a little concerned that fundraising is going to be very difficult, and it became indeed difficult for some of them, I'm sure. So we're seeing a little bit of down rounds as well. A bunch of startups are doing down rounds. A bunch of startups are doing a bridge round so that they can come out of this pandemic and they can do a regular round. So we are seeing some good opportunistic investment as well as a VC. So we're seeing that as well. Pricing is definitely a good concern. So I'm sure that if there are startup founders who are also attending this seminar, I would advise that price it well, price it in a way that you can raise the capital faster rather than in missing the moment. Not any time is a bad time for fundraising. People are investing in the right company, and for there to be a right company, you should have the right valuation for sure.
Right. But going back to our Y Combinator conversation, I'm trying to square the two. I'm kidding. Jem, so one last question for you before we go to the audience side of this. I'm very curious about corporate venture capital as a portion of the broader venture capital market, because on one hand, American corporations are incredibly cash rich, to pick one segment of the world. And so they have probably more resources than ever to devote to investing activity, which I'm sure Honest is really glad to know because he likes to manage all of it. But at the same time, the traditional venture capital world is also incredibly cash rich. And so I'm curious, do you see in the next couple of years, the corporate venture capital world taking a larger share of the private investing market, or will it remain maybe static, given that everyone is just so wealthy today?
Well, I think whenever there's a lot of capital out there, there's going to be competition for those deals. I do think you've seen an increasing trend over the last 5 to 7 years in terms of the percentage that CVCs have played. And I think that will continue to increase. It may not increase at the same rate, but it'll keep going upward. With the way that many companies have really trimmed their R&D internally, this is really the way that they're doing. They've shifted to an external R&D model, particularly in the life science field. And so you're going to continue to see that increase because they've got the cash and they don't have the same set of resources internally that they might have had 15, 20 years ago in terms of developing that next generation technology. So the additional capital that's out there will, keep it at a relatively similar level, but I think you'll continue to see an increase going forward.
It's going to be very interesting to come back together at some point in time when the stock market isn't doing this and instead is doing that, and see how this conversation breaks down. But I promised everyone who's with us that we could take some of their questions. And thank you, everyone. We had 23. We're going to get to about 3 of them. So thank you all for writing in. We'll do our best. First up, guys, from Emily Moraes, I think. She says, how do you expect the change in the White House to impact corporate venture capital and venture capital activity in the coming year? And I don't have an opinion on this. I'm curious, either one of you, what impact might the change in administration have on your business?
So I will quickly add, Jim, my comment on this one. I am hearing that, and I hope it does not happen, that there will be an increased capital gain tax rate. That's what I'm hearing. And I hope that is not the case, because this will discourage innovation. In many countries that we invest in, capital gain is tax-free, actually. So that people are encouraged to invest in startups. People are encouraged to foster innovation, and people are encouraged to investing in startups as a sector of investments, right? Because there are many vehicles through what you can invest, and startup is one of them. I'm hearing that capital gain is going to get increased. I hope that does not happen. It is at 20% now. I hope that remains the rate for the moment. I also hope that corporate tax rate does not increase. We enjoyed the around 20% tax rate for the last few years. I hope that remains stable as well, because that impacts our bottom lines at the end of the day, and that impacts the overall innovation ecosystem as well. So I hope, Alex, you'll write a lot about that so that it is not increased.
I don't think you would like anything that I wrote about that, honest, given that I am taxed far higher on my labor than I am on my capital gains, which to me, given that one is work and one isn't, drives me bonkers. But my own politics aside, Jim, over to you. Same point. New administration. How do you feel?
Yeah, I think there'll be a mixture. There'll be some, as with any change, there's going to be some factors that increase, some factors that decrease. So, increased immigration may help drive some more of the innovation economy. That there's been some challenges on that front from some of the technology companies that are looking to bring in more talent from overseas that have run into roadblocks. That might those roadblocks might lessen. I think that you'll see certain industries really benefit from the change in administration, whether that's clean tech or other areas that will be more of a strategic focus for the current administration than the last administration. And then there'll be some tailwinds as well. So it'll be a mixture, but overall, I think there'll be some strong positives.
Okay, just because we don't have a lot of time, I'm going to throw some more in here. From the well-named anonymous attendee, here's the question. Based on your experience in life science drug development companies, do you see better pre-money valuations and size of investment for SPACs or traditional IPOs? And I grabbed this question only because we did get to SPACs, so I feel obliged to grab one from the audience. So Jim, probably one for you.
Okay. Happy to answer that. So I think one of the main advantages that SPACs have is price certainty. So setting aside kind of the question of valuation and where you're getting better valuation right now, which I'll address here in a second, it's price certainty. So with a SPAC, you're really negotiating with one party up front and coming to an agreement on the valuation, as opposed to with a traditional IPO, where you're going through the full process, not knowing precisely where that's going to price until the actual IPO itself, or very close in time to it. In terms of valuation, it really, with so much money sitting in SPACs right now, there's going to be a lot of competition, particularly in early 2021, because those SPACs have a certain timeline. And so they need to get those investments done, and they need to deploy that capital. Otherwise, they have to return it to their investors. And so that's going to put some pressure on valuations when working with SPACs as well, in a good way for many companies.
Sure. And then honest, over to you. Any comments on that one?
So as Jim mentioned, I think if you're trying to secure an exit in the short term, SPAC is the answer. And once you are part of the SPAC and you're in the public market, you can grow your valuation from there. That's the best way to go. We're seeing a lot of cash, I would say, good revenue company who are having a good revenue and a valuation of, I would say, $1 to $2 billion. They are actually choosing the SPAC round because SPAC is giving them an easy $3 to $5 to $6 billion IPO, rather than waiting for the real IPO. Whereas Jim mentioned, the decision is going to rely on a lot of different factors. Whereas SPAC is kind of like a one-person call in some sense. So yes, if your size is there that I just mentioned, then most probably SPAC is a good answer. SPAC will give you certainty. Your valuation will be not as big as you will expect in the IPO, regular IPO.
Got it. So trade-offs there. So we have a question from Yuriko Izihara, and they ask, what impact will a capital gains raise in the US have on venture capital and corporate venture capital activity? And honest, I'm bringing this up because I'm just curious, your read on this. Let's say capital gains tax went to 25% in America, just to pick a number. How much would that dampen investment into startups?
So I think, for the corporate clients who are not really looking into making money or making a capital gain, rather they're valuing the relationship with the startups and collaborating with the startups and having more collaborative advantage out of it, they will not care. But it will discourage the venture capital community itself, where it will be very difficult for them to operate something and still exist as a business, as a venture capital business. So, and also it will discourage a lot of angel investors and other type of investors who are also investing for capital gain. So corporate investors will not be impacted that much. Their capital gain will decrease because of the higher tax rate, but it will not stop the activity at all in some sense. But I think the ecosystem is going to get hurt in a big way.
I'm going to mark that down as honest is in favor of a capital gains tax increase. I'm just kidding. Jim, I'm curious about your perspective. Is honest being too optimistic, too pessimistic? What's your read?
No, I think he's hit a number of key points here, because there are going to be impacts throughout the ecosystem if that change happens at each level, from angels to VCs to
Sure.
the CVCs. And again, on CVCs in particular, and corporate investors, that's going to vary depending on that strategic focus, how much of it's financially driven versus how much of it is strategic. But if there are changes in the number of opportunities available, or just the trend lines in the industries, historically CVCs have sort of followed along in terms of the trend lines of the VC industry. So when it's hot, it's hot. When it's not, it's not. And if that starts to decrease a little, that may have an impact as well, though probably less than it did historically in terms of dips.
Okay. I'm going to save this Pegasus question for Honest for a second. That'll be our last one. Second to last, Jim, why don't you take this one? This is from Krishnaswamy. They ask, do you see more investments going into AI startups, particularly in the B2B space in 2021 and beyond? So amongst the people that you work with, is B2B AI particularly hot? And then do you think it's going to see a gain this year?
Yeah, so AI in general has been a focus not only of VCs, but particularly of corporate investors as well, as every company has kind of recognized that there are aspects of AI they need to incorporate into their business, or thinking of incorporating. Many aren't sure exactly how they want to do that or how they go about doing it. And so I do think that this is an area where we've seen many CVCs really focus on AI generally, and then B2B as well, in terms of looking at how do I explore this space, and making investments is one area they've found to help them gather that information, develop that ecosystem, and evaluate how they want to approach it. So I do think there's going to be continued strength in that sector.
Yeah, that's my read. So Honest, just quickly from you, are you seeing similar demand for AI startups in general, and perhaps in the B2B space?
AI, demand is continuing. I think, we have invested in a bunch of them. And I think we're still seeing the demand for AI startups, especially, with some of the supply chain moving back to different countries. I think we are actually going to see an increasing demand of AI and robotics that actually equals to automation, right? More automation in the factories where you need less people. You have a pandemic like this happens, you are not going to get impacted that much if all your factories and supply chains are automated. So yes, you will see some increasing growth of AI and robotics and automation overall. I think also non-touch is a very big keyword. Amazon Go has changed the world, how the stores need to look like.
Mm-hmm.
And then, driverless delivery, autonomous vehicle-based delivery. We have seen some companies like Neuro, all over in Silicon Valley, they're delivering with robots and stuff. So you will see a lot of application in the robotics field of AI. AI and robotics will work together and bring in automation for the delivery, for the supply chains, manufacturing, and elsewhere. And that's where the area will see a growth within the AI space in 2021.
Okay, and just to close us off here, because this one is perfect for you, Honest. Paul Thurston asks, what is the average check size for Pegasus funds? Now, I know the answer varies, but perhaps you could give us a range of what's kind of normal.
So I will say that on an average, we'll invest like, say, I would say $3 to $5 million in a deal. Our highest check size can be up to $350 million in a company, and it can be as low as 100K for a Y Combinator startup.
So pretty much everything from a seed round to a SoftBank Vision Fund. Okay.
That's correct. So we have—
that's flexibility.
Yeah, we have a bunch of funds. We have 28 funds. If we mix and match, our check size can vary quite a bit. That's what the magic is.
Yeah. Guys, we are out of time. A couple of quick notes before we all go. One, thank you everyone for showing up. Of course, a big thanks to our two panelists, Jim and Honest. I have been told that there will be a follow-up sent out with Honest's trends write-up, and I think also a recording of this event. So if you wanted to listen in to this again, that will be coming out your way. Thank you to everyone who sent in questions. We really appreciate it. My name is Alex. A real fun time to be here. And with that, gentlemen, I think we're done. So thank you for coming.
Thank you very much.
Thank you, everyone.
Thank you, everyone.